Hello, everyone, and welcome again to this week's episode of Policy and Profits. I'm Anthony Esposito of Ascalon 6 Capital. Thanks again for joining. Interesting topic this week, a topic we've been on quite a bit. Mr. Jerome Powell came out with some additional comments after the 25 basis point cut last week, which he has been saying is off the table, not sure why, but made that cut with the Federal Reserve Committee, Open Market Committee last week, and then came out with some additional comments. So we're going to try and go through and kind of figure out what he's thinking, where he's at, and take a little look back at how the data has changed or not changed from his insistence upon not cutting to then cutting ahead of the election to then not cutting to now cutting. So I think we have some quick tape. We actually got some undercover tape of him driving to the FOMC meeting last week. So we're going to run that quick, take a look at how he gets there. Is this the right tape? Yeah. Yeah, it's about right. See, for me, this is really the equivalent of how Jerome Powell runs monetary policy and the FOMC, Open Market Committee. The Fed is really being run in a chaotic way, an irresponsible way. I have really nothing else to do except kind of smile at this and laugh and try and move through and just point out how ridiculous policy and management of not only monetary policy has been, but how ridiculous the management of the balance sheet at the Fed has been. And there's no question we've been through some difficult events within the country. The economy's been difficult. There have been geopolitical risks. We've hit COVID. There's been a number of items that presented challenges, but the inability to manage those challenges, to me, and then to manage some of the events in a politically biased way, to me, is a clear indication that Jerome Powell is either not capable of doing the job or is just too politicized to do the job. So, all joking aside, we have a clip from yesterday. Jerome Powell was out with a quick blurb. Let's run that and start to dig into exactly what he's trying to say and do.
We're now collecting a good bit of revenue. The federal government collecting a good chunk of revenue, $300 or $400 billion a year pace. And the question is, who's paying that? And the candidates for paying those tariffs would be the exporter, the foreign exporter, or someone on our shores. It could be a company or a retailer, someone who's using the imported product to manufacture something, or the end consumer. And so so far, in its incredibly early days, it doesn't look like the overseas exporters are carrying the bulk of it. It looks like it's that middle group. It's retailers and it's importers, and they're not passing along to consumers that much of the cost. So the actual effects on inflation have been quite modest so far. It's really not. It's a small amount, but I mean, for example, I mentioned that core PCE inflation is 2.9%. Maybe 0.3 or 0.4 of that is tariffs. So it's not the big factor. It's not a big inflationary thing, but it is something that is driving up inflation a bit. And the question is, are companies then, are they going to eventually be able to pass that stuff through? And then that might drive inflation up a little higher. So we've been watching this since the beginning.
So let's just look at this for what it is. I love the tariffs might be 0.3%, 0.4%. For somebody who's so data driven and should be so quantified, I find the word maybe in there kind of comical, but what he's talking about as far as tariffs is the conversation that should have been happening 8 months ago. These are the conversations that were logical thoughts moving forward. In addition, tariffs, as EJ and I, when he was on with me, said a year ago, there was no academic study, no real world experience or real world event where tariffs were inflationary. There was zero reason to think that tariffs were going to be inflationary, especially in particular for the United States of America, who is being abused abroad in trade deals and trade deficits and outsized tariffs being charged to us. We are clearly in a position where tariffs were going to benefit the U.S. and that they were not going to be inflationary. If that was going to be the case, that was the lower probability event, yet Powell had the scale flipped and had it as a higher probability event. Why? Well, it gave him a reason not to cut rates in the Trump economy, whereas back in September, heading into the election, he cut rates 50 bips heading into an election in the Biden economy, if you want to call it an economy, in the Biden smokescreen. So the tariff conversation was a gift for Powell, and he hid behind it as the potential for an increase in inflation. As we saw the data roll in, we have seen annualized inflation numbers drop. We have seen annualized CPI drop. We have seen PPI drop. And the portions of CPI and PPI that are showing some life, meaning those prices and those pressures are higher, are actually in services on the PPI front, have nothing to do with tariffs, right? And then on the CPI front, we're starting to look at owner's equivalent rent, which is a flawed survey to begin with. Okay, so we never saw inflation. We never should have been preparing for inflation as far as Fed policy goes. But he hid behind that. And now he's starting to backtrack because the numbers are what they are. His back is to the wall. And President Trump and Secretary Bessent, to their credit, have been vocal in the fact that Jerome Powell is not looking at the data and he is not objective. He's biased. His decision-making process is biased. They're calling him out on that. And I would say that is not a Fed that's not independent. The vocal criticism of the Fed with facts to back up those criticisms is actually in an effort to do just the opposite. That's an effort to keep the Fed independent, data-driven, unbiased. That's the point. The second point is, I don't understand how Jerome Powell is so far behind the curve when he should be looking at the BLS non-farm payroll numbers across the board. He has a dual mandate for maximum employment and stable prices. He's falling short on the stable prices he has from the get. That has been a disaster, clearly, as we saw him not in any way helping the process during the Biden administration, not in any way help with Fed funds policy or acknowledge where the real inflation was coming from, Mrs. Yellen, deficit spending and debt creation. Now we look at non-farm payroll. So let's just look at this for a second. He's starting to talk about the fact that jobs look weak because of the recent 911,000 job revision down, right? So in the U.S. BLS non-farm payroll preliminary revisions, we just saw a revision down by 911,000 jobs. Now he's using that as a reason to say, I can start to cut rates. I can back off here because his back is to the wall. My question is, in 2024, in 2023, we saw revisions of down 306,000 jobs, down 818,000 jobs, now down 911,000 jobs. Understand, these revisions come in each month. It's not like you're trying to make a decision, Mr. Powell, on Fed policy and rates, and at the end of the year, it's a look back and you're like, oh man, I can't believe they revised down that much. All the data was wrong. You saw, we saw, the world saw the data wrong each month. Those revisions were down every single month from the prior month under the Biden regime. It was a smokescreen of jobs. The quality of job being created, I have been over 1,000 times, was junk. They were government jobs. They were government funded jobs. They were low paying, low skilled jobs. And they went to non-native born people. Okay. So net job growth going to the wrong group, and it's the wrong place. And most of it was funded by the government. And on top of it, you're seeing a monthly revision down. So I don't want to hear that you think that tariffs were going to create inflation and you were worried about inflation under President Trump as inflation has dropped and tariff revenues have increased. And I don't want to hear that all of a sudden you're aware of a job market non-farm payroll numbers that are weaker than you thought. They have been weak on a monthly basis for years. The BLS, and President Trump rightly eliminated the head, now has E.J. Antoni in position to take that job, which will be a significant improvement EJ is objective, data driven, and will fix this process. But we had monthly numbers that were wrong for years, jobs that were never created. You knew they were there month to month, but your decisions were politicized. You ignored them when you needed to, and then you acknowledged them when it worked for you and your agenda. That's unacceptable. That is unacceptable. There was a gentleman that told a little story about him taking his wife on vacation. He wanted to take her to a very scary place. I'm going to run that clip just for a little chuckle to see what that scary place was.
Also, I'm banned from planning anything because we went to D.C. and she wanted to go to this haunted house, and I brought her to the United States Federal Reserve, and I said, this is where the real horrors happen, and she said, it's not scary. I said, I haven't told you about fractional reserve banking yet, and then I showed her a chart of all the single-family homes Blackstone purchased, and she said, it's not scaring me. I said, well, it should, and...
Listen, well done. Well done. And, I love the comedy. I love being able to laugh a little bit and just have add some lightness to this. But the bottom line is this is extremely scary. And there's been a lot of damage done to the economy on accident, on purpose. And I do believe that. I don't believe that the previous administration and those in place, and this includes Mr. Powell, could be as unaware or inept as their actions show. And that's really sad. And it's a serious thing. And I take it very seriously. The economy overall, people's kitchen table issues, bringing home enough dollars to support your family, to buy food, to put gas in the car, to do the best you can for your children. That is part of the government, and institutions should not be making that harder or impossible. There should not be a challenge and roadblocks put in place for the citizens of this country because of political views or ideology or biased action. And if that is the case, and you're in a position, whether elected, then you be careful at the next election. That's our process. If you're appointed, how dare you tell an elected official, especially the President of the United States, that you're not leaving your seat, that you're not willing to step down? You are appointed. You are appointed by the President of the United States, and the administration has a right to remove you if you're making this harder than you need to. And there are a number of people doing that, and I believe Jerome Powell is one. The last clip I have is really, Jerome Powell has amazed me in a lot of ways, but he's amazed me over the course of his tenure in that he has continued to refuse to stay focused on the mandates. So I have a headline here from Barron's with a nice picture of Mr. Powell. Looks pretty good. Good hair day. I'll give him that. That is a good hair day. I think I'm actually having an okay hair day too, but his is pretty solid. He's out again talking about how highly valued the stock market is. Mr. Powell, I don't want to hear you talk about CO2 in the ozone. I don't want to hear you talk about DEI. I don't want to hear about equity. I don't want to hear about kitchen table issues while you're speaking, while you're doing your job. I don't want to hear about the valuation of the stock market. I don't. And you shouldn't be talking about that. You should, and you have all of those topics. You should be talking about full employment and price stability. Okay, those are your mandates. Stay focused. And by the way, price stability, for anyone that doesn't know, is defined by the Fed as an annualized inflation rate of 2%. I don't know about you guys, but just think about that for a second. The target for the Fed is to have annualized inflation at 2%. That is a compounding annualized inflation rate of 2%. Think about over time how that degrades and destroys the value of the dollar. That's their target. Now, I'm not, it has been for a long time. And I'm not saying that there's an easy way to adjust this policy. And I'm not saying it's not very complicated. What I am saying is think about what their target means. That means that every year on a compounded basis, your dollar is going to be buying 2% less and less every year. It's pretty amazing to think that that's the target. We say it like it doesn't mean anything. It's all over the broadcast news. It's all over documents. It's stated by the Fed. Just think about what that really means. And think about how much better we would be domestically, globally, with a stronger, stable dollar that was not targeted by the Fed to actually lose value every year at a rate of 2%. It's pretty interesting. As far as Mr. Powell's assessment of the stock market, I am at Ascalon 6 top down and technical. I will be very clear. I do not hold individual equities. I am all futures. It's a managed futures account. I am out in the S&P and the Russell 2000. I am out in gold. I am out in crude, and I am out in front month VIX. That's the model. I have a unique and proprietary system, technical momentum trend model, where I manage those assets within the portfolio, and it's been relatively successful. But if we want to talk about valuations, let's talk about valuations. When I do talk about valuations, I always refer to the Shiller PE. The Shiller PE is the inflation-adjusted PE ratio for the S&P 500 on a 10-year basis. So we're taking into account all of those inflationary pressures, and we're saying, what is the real PE adjusted for inflation? From 1995 to 2025, just to give some perspective on this, on a fundamental basis with the Shiller PE, the average is 17. In 1999, we peaked at 44. We saw a 50% sell-off in the following the subsequent bear market. In 2007, heading into the housing crisis, we saw a peak of 28. Very unique situation, subsequent sell-off of 60%. In 2021, we saw a peak of 31. That was on that massive consecutive run of new highs. At the end of 21, let's just recall, Powell was at Jackson Hole in August of 21, and he went from a lower forever policy to I'm going to spike rates at 75 bips and push higher. He created a regional banking crisis. He created a balance sheet crisis for himself where he continues to lose $100 billion a year because of mismanagement. And then we saw Russia-Ukraine, and we saw a 27% dip in the subsequent bear heading into 2022. In 2024, recently, and I was out on this multiple times, we saw a peak of the Shiller PE for the S&P 500 at 37. We saw about a 22% peak to trough sell-off. We are now at 40. So we are now above the 24 peak, just below the 1999 peak. For further reference to valuations, and I think this is great, I was looking through some numbers today. The market cap for NVIDIA and Microsoft is $8 trillion. Let's talk about concentration for a second. That is about 14% of the S&P. So two names out of 500 that make your S&P 500 index account for 14% of that index. Breadth not so great. That distribution is not so great. For further note, Germany, which is the largest economy in the EU, Germany has an annual GDP of $5 trillion. So we now have a market cap between NVIDIA and Microsoft that's almost double what Germany's annual GDP is. Think about it. Think about how inflated this market is. Now, having said that, and I do love to hate them, I'm always prepared for the volatility. We actually do much better with volatility in high vol bear regimes than we do in low vol bull regimes. We'll make money both ways, but those high vol moves have historically been very productive for us here and for the P&L and the strategy. I'm not saying that we're going to crash now. I'm actually out on my morning note, which you can get at ascalon6capital.com, or you can get out on X at CMT_Anthony. It's a morning note on the S&P cash only, and I am running my signal there. You get my signal and a brief description of the index and where I think we're going. I'm not saying that we're going to crash now. I'm not saying that we're going to dip 5 to 10% now. I actually think that technically we're set up, and I've been calling for an S&P cash level into year end or before year end of 6,700 to 7,000. That view has not changed. What I would say is, as we hit valuations this high, historically high, and as we start to see a shift in momentum trend, not only in the short term, but intermediate and long term, which we will, and the timing of that to me really is not that important because my model will show me as we're starting to get towards those turns, and we will, within the portfolio, adjust appropriately on risk and exposure. as we get to those turns, the aggressiveness of the move down at levels like this will be significant. In my opinion, they will be significant. So there is upside. We are definitely valued, very highly valued. It's lofty. There is room to run, in my opinion. That's what I see in the model and the technicals. And historically, yeah, there's definitely room to run. But I would be very cautious as we start to see nicks in the armor and we head into another recognition phase. And that may be in 3 to 4 months. That may be in the turn of the year. That may be in 2 years out with another catalyst. I don't know. But I will tell you that valuations are lofty based on the Schiller PE. Near term, 3 to 6 months, technicals right now look pretty constructive. And I do see risk you to the upside. And I would say that for the love of God, Mr. Powell, try and focus on your mandate. Try and do your job. Sit in your seat. Stay in your lane. And if you can't help fix it, please stop breaking it. That's it for this week's, guys. I appreciate the time. Again, Anthony Esposito here from Ascalon 6 Capital. You can visit the website, ascalon6capital.com. You can find me out on X at CMT_Anthony. More than happy to respond to any emails or inquiries. The email address is right there. It's anthony.esposito@ascalon6capital.com. Be well, be safe. See you guys next time.